morning, and welcome to the weekly mortgage market update and the non-QM panel webinar. Please let me introduce the president of CAMP, Ms. Audrey Boissneau. Audrey?
Thank you, Megan. Good morning, everyone. Thank you so much for joining us. I just want to congratulate all of you on making it through this far, because today we are all about good news. I want to say thank you to Kevin Casey and Megan Jackson. They are here as well as our panel, but before we do all of that, we're going to do our weekly update. A few little maintenance things ahead of time. We have a happy hour this Thursday, so the flyer has been going out, posted on social media, so please sign up and join us. We'd love to see you for that. On May 28th, we are having an NMLS 8-hour continuing ed class taught by Kevin Casey through Mortgage Educator, so that will be great. Yes, David, it's great. They had a good class last Friday, and so it'll be a good turnout, I'm sure, this next time too. Please be a CAMP member. Please, please, please. We are a group of volunteers with a heart for our industry, and we just need your support. At the very least, just be a member. Go to thecampsite.org, www.thecampsite.org, and either join or renew your membership. We've had a lot of brand new members, a lot of renewals, and we really appreciate it. So keep it up and get that done today if you can. We have had 20,000 responses to the servicing call to action, so keep your eyes out for calls to action that are sent by either us or NAM, and make sure that your voice is heard in the industry. And then what our format today is a little different than it has been. We invite you to please ask questions, send them through the chat. But the way we're going to do this today is Dave Luna is going to give his market overview, and then we will move on to the non-QM panel. So with all of that, David, please welcome. Thank you as always for being here, and tell us some good news. We're very excited to hear it.
You know, I think, you know, how I give the market information and then at the end I do all the good news. I don't have any bad news today. So I want to start off with the biggest news from FHA today. New borrowers do not have to wait 12 months after forbearance to do a purchase or a refi. Can we get a woohoo on that one? Woo! Borrowers
Thank God.
This is coming from FHA, so I'm going to read it. This is so cool. Borrowers are eligible to refi or buy a new home if they are current on their mortgage. Whoop, what if they're not? Forbearance, but continue to make their mortgage payments or reinstate their mortgage. Borrowers are eligible to refi or buy a new home. Listen, folks, 3 months after their forbearance ends. No more 12 months. If a borrower called you yesterday, you said 12 months. If they called today, it's only 3 months. If they've made 3 consecutive monthly payments under their repayment plan or payment deferral or loan mod, 3 months. Homeowners who are in a COVID-19 forbearance but continue to make their payments on time will not be penalized, said Director Mark Calabria. Today's action allows homeowners to access record new mortgage rates, new low mortgage rates, and Kevin will tell you what killer rate he locked for his borrower. Kevin, whenever that is, today, yesterday, whenever you did that, it was so cool. Okay, and keeps the mortgage market functioning as efficiently as possible. So enterprises will now be able to buy forborne loans with note dates on before June 30th. I think that's fantastic news, and will virtually guarantee that for the next few years, all of us are going to be making money as we help families with homeownership. Okay, Friday, the House passed the HEROES Act. We don't know the fate of the HEROES Act in the Senate, but a key part of the bill is Division K that contains several key provisions impacting homeowners and renters across the nation. We all know that bills die, get changed, pass both houses, get vetoed by the president. You know, we don't know where the HEROES Act will end up. We'll spend more time on this if it becomes law. Sad news. Another 3 million people filed jobless claims last week, bringing the total to 36.5 million people. However, I said this was a good news broadcast. The rate of forbearance requests has been slowing for the last 2 weeks. This may mean that we have hit the top of that growth of borrowers asking or needing forbearance. I mean, that's really, really good sign because we passed the 15th of the month. Let's see, you know, we hear about the flattening of the curve on the coronavirus. this flattening of the curve is also important on forbearances. States are starting to open, stay-at-home orders are starting to lift. The next couple of weeks are important to see whether the unemployment rate can stop increasing, start to decline, and many of those good folks can get back to work. 8% of all home loans are in forbearance, Black Knight said on Friday. Mr. Powell, Secretary Jerome Powell, and Secretary Mnuchin are testifying today before the Senate Banking Committee. We're just trying to see, what's going on. They're going to criticize these folks because $75 billion that has already been allocated under the CARES Act is there helping, or supposed to help mid-sized businesses, but not a dime has been spent. Housing Wire reported that refis will be at a 17-year high this year. People, that's $1.5 trillion in refinances in 2020. For those of you that are not on the refi side, but are on the purchase side, the National Association of Home Builders said on the 14th, quote, prices paid for goods used in residential construction decreased. Gypsum, softwoods, concrete, they were all lower. Builder confidence is up, and they're saying, housing starts are better than they were in April, which was disastrous. Fannie and Freddie are still trying to get out of conservatorship before the November election. We're going to see if that happens. 80% of their stock preferred, which is now held by the government, will be put out for people to buy. That would be the largest stock offering ever. Now, some of you guys keep asking questions on credit reports. How are they marking them? They got to mark them current as per the CARES Act. But Experian, let me just tell you, credit bureau by credit bureau, what they're doing. Experian is in the comments line, the notes line, the memo line, they can write affected by natural disaster, account in forbearance, even though it's marked current, principal deferred / interest payment only, Equifax, affected by natural disaster or account in forbearance, and TransUnion's got 4. Payment deferred, principal deferred interest payment only, loan modified non-government, loan modified under federal government plan. And ladies and gentlemen, that is my update for today. I turn it back over to Audrey and our distinguished panel. I want to just ask Kevin just for a second. Kevin, before we started this, you said something about you just locked a Govy loan at what?
2.75, no points on a 30-year FHA. Purchase, 3.5% down, 2-unit building.
That's phenomenal. That's phenomenal.
Hallelujah.
Madam President, I turn the controls back over to you.
Well, thank you, David. That was short and sweet, but a lot of great information. And just to be clear, that was FHFA that rolled that out. So Fannie and Freddie will allow a refinance after 3 months. Any word from Ginnie? Do you think they'll follow suit?
Don't know. I mean, but if you were to ask the industry yesterday, everybody in the industry would have said 12 months. So this is just catching everybody off guard. We don't know what Ginnie will say. And we all know that they've been paying, in different camps. Ginnie with liquidity and FHFA without. So who knows? Tomorrow, we might have to do another webinar.
Well, and that's why we've been doing these so regularly. And I will say that last week when we had Barry Habib on, he mentioned that in his conversations with Mark Calabria, they were talking about this and that they were considering it. And so here we are. So thank God. That's good news. That's great news. So at this point, we're going to move into our non-QM panel, and I'm very, very happy to see this happening today because I have wanted to do something of the sort since all of this melted down, so to speak. And it finally feels like we are moving in the direction where we can offer a non-QM panel and know that everyone will be around long enough to fund the loans. That was my concern 2.5 months ago. So with no further ado, I just want to say thank you. We have Carrie Anderson with Axos Bank. She's an account executive. John Wise, who's the VP Regional Sales Manager for Angel Oak Mortgage Solutions, and Steve Abreu, who is the president of NewFi Lending. So welcome, everybody. Thank you so much. And I think that a lot of us are really interested in what happened. Like, why did non-QM just go away overnight? And I know that for some of you, it didn't quite happen that way, but talk about talk about what happened. Let's start there.
Let's have ladies go
Sure.
first. Carrie?
Oh, there you go.
I'm actually,
Absolutely.
I was saying either John or Steve should take this question because my business model is a little bit different as a bank. So, yeah, the whole why did it go away is largely secondary market question.
I can start with
So,
you, Audrey. So what
Go
really
ahead,
happened,
Steve. Yeah.
the credit facilities that the large buyers of these mortgages had in place really evaporated it, and they all got margin calls. So they had to really come up with collateral to go against those credit facilities on Wall Street, and those are the first things that dried up quick. And once you lose your facilities to borrow against and securitize with, you're kind of out of business. So at the end of the day, it's more of a liquidity issue, and it dried up fairly quick. So in 07, 08, it was over 8-9 month period with subprime happening first, and this happened in about a week and a half. So, prices at 103 to 105 for paper went to 85 in about a 2-week period. So what happened was people got out of, go ahead.
I was just going to say, so just a lot of our audience are loan officers who might not know all of the secondary lingo. So maybe explain what facilities means and what some of the terms that you're using mean.
So except for, Carrie's business, which is a bank portfolio that's buying the asset into a bank portfolio. So they have deposits on at their bank, and they can buy the loan with those deposits. So it's, more of a portfolio loan. The conduits and the secondary marketing players obviously don't have liquidity from a bank, so they have to borrow money from Wall Street. And so when the crisis hit, the more riskier of assets are the ones that dry up first. So what happened was the REITs and the big conduits, those facilities, warehouse lines that they borrow from Wall Street went away.
Got it.
Like overnight. And so what happened was, definitely with the REITs, they got margin calls. So they had to come up with capital against those credit facilities so they can pay down the lines that they had in place. And with that came a lot of selling of assets to raise cash to pay down those lines of credit. So you really saw that in the REIT sectors where the REITs are trading at, way below book value right now. And then it happened with all the large takeouts for the paper, dried up really, really fast. So it's more credit facilities or warehouse lines that these big conduits had to borrow money from to hold on to the assets and then issue a securitization. And that's what dried up fairly quick. And so what ended up happening is a lot of mortgage bankers got these loans trapped on the warehouse lines, and everybody came and flooded the market with that paper. And so the sharks came out and was buying that paper at deep discounts so people can get these loans off their warehouse lines.
So there weren't any borrowers on the back end for these loans. That's what happened essentially, is people stopped buying them or investors stopped buying them. So then the guys on the front line stopped lending.
That's correct.
Is that a simplified, dumbed down explanation for what actually happened? Okay.
Yeah, I would just add a couple things. One, and before I start, I'd be remiss if I didn't say thank you to Audrey and Kevin Casey and Megan Jackson and all the people at camp for what you guys have been doing, not just today, but over the last couple months. You guys have been an incredible voice for the mortgage banking, mortgage broker community. The information that you provide is invaluable, but you've also been a voice for us, so I appreciate what you've done, and keep up the good work. For those of you who are on the phone that are not members of camp, I would encourage you to join. Now is the time. Now is definitely the time to make that happen. But in addition to that, we've also had some incredible people on the panel. I appreciate Steve and Carrie being here today, but David for all the work that you've done over the last couple of months. People like you, Barry Habib, Kevin Peranio, Dave Stevens, just an incredible group of people sort of spreading the word and making our voice heard, not just here, but sort of throughout the United States. So thank you for what you're doing. Just to fill in for sort of Carrie's thoughts and Steve's thoughts, I think the great news about where we are today is that this is not a credit issue. This is a COVID-19 issue. And that's, I think, really important for any discussion that we have sort of today and going forward. Is that this is unprecedented, but it's good news in the fact that it's controllable. So this is not where we were a decade ago, where we had a credit issue. These were good loans performing to good borrowers. Reasonable loans to reasonable borrowers is what we've always called it. So that's sort of the preface. But in terms of what happens, I think, Steve's exactly right. I mean, what we do, I think, as an industry is we provide, or at least try to provide, efficient access to the capital markets. That's essentially what we're doing as conduits, and that's been our mission at Angel Oak, sort of all along. But what happened is Steve's right. The market dried up, so people started looking at and this wasn't just non-QM, but this is prime jumbo. All sorts of questions started to come up about how are you going to effectively underwrite and price credit risk. During the middle of the pandemic, when it first happened, there was just no way anyone could properly identify a good loan from a bad loan, because you didn't know who was going to survive the pandemic and who wasn't, and who was going to be impacted and who wasn't. And then as a result of that inability to underwrite credit, and to properly price it and put a proper loan to value on it and a proper debt to income ratio, all these things that we do on a day-to-day basis, it did cause a liquidity problem. So the problem that Steve's talking about is warehouse banks started to pull out of the market, so you couldn't get financing as a mortgage banker to close these loans. That caused an inventory of loans. But really the big issue for people like us, and I'm glad that Carrie's on this call, because she does represent a little bit different market, a little bit different way to do business. But the bulk of the non-QM growth over the last 5-6 years has come because the securitization market has been so fruitful. It's been such a great place for people to invest back in these assets. Good loans for good borrowers that are paying well. I mean, the demand has always been, not only was, but and I'll get to that later, but is currently higher than the loans that we could produce. So there were more people that wanted to buy and invest in these loans in the secondary market than we just couldn't produce enough of them. And that's why you saw this kind of massive growth from 2013 through 2 months ago. We closed 25 billion and 30 billion of securitizations in 2019. We were on track for about 50 billion of securitization in 2020, and that was all because you had not only demand to buy these loans, but you also had an acceptance at the origination level that had started to take root. And so anyway, it's just I think between all of that and the fact that these loans are not government backed, which is I think another important part of the discussion, is agency business continued, the FHA business continued because you had government support there. The fact that there wasn't any government support for an industry that was still really in its kind of infancy stages, I think also kind of played an important part in sort of what happened.
Okay, well, that's a lot. So here we are. We are, a couple months into this now, and there were some people, like Carrie was saying, that her offerings really didn't change a whole lot. And so I'd like to speak to, where are we today? So Angel Oak had stopped lending. Now they're lending again, slightly different lineup. Carrie, I'd like to hear from you a little bit about where we are today. And Steve, same thing. So why don't we start with Carrie? She's, again, your model's a little different.
It is.
And you're with a bank, so tell us how that works.
Yeah, so my company is Axos Bank, formerly known as Bank of Internet or B of I Federal Bank. And I've been with the bank since 2010, when we were in the midst of the aforementioned mortgage meltdown and crisis. So we came to the table with product that nobody had seen for a while and didn't expect to see for a long, long time. And we could do that because we are a bank. We're a well-funded bank. We have grown exponentially since I've been a part of the great bank. And now we're doing some of the things that there's a huge need for, like the aforementioned warehouse lending. We have warehouse lines that are becoming fairly popular. Also, we're doing the paycheck protection loans, and it's been just a really great feeling to be able to help the community. As far as doing the non-QM stuff, it's what we've always done. We've always been more of a jumbo lender, going up to loan amounts of 30 million on both residential and commercial. So we're still doing that, and we've had specialty programs before non-QM was cool, such as asset depletion, bridge lending, cross-collateralization, just taking a very manual and common sense approach to complex tax returns, higher debt ratios, credit flexibility, all that we've done, foreign nationals as well. We were kind of late to the party on the bank statement programs that were really hot and the debt coverage, and we had come out with a pretty flashy product, and then about a week later, everybody lost those loans. So, and we were not keeping those on our books. So we're back to doing basically what we've done from the start. We are still funding the bank statement loans, lower LTVs than everyone's used to, but there's still demand for it out there. So I think the market's coming back, and you know what we've done to answer the issues at hand is we have constricted the LTVs a little bit. We were already a low LTV lender for various reasons and risk. So not that much has changed, but I have seen a pickup in business, obviously, as being, you know, one of the only games left. So that's great. And I just think it's about getting the word out that there are still non-QM lending options out there. They're not everywhere. So you have to dig for them. You have to look for them, but they are out there. And jumbo, John was just talking about jumbo and the liquidity there. We're still doing jumbo. We do loans up to 30 million. So it's out there. You just have to know where to look.
So just to give us a sense, your highest LTV that you go to would be
70.
Great.
Yeah.
Okay. So, I mean, it's something, and I mean that's not a low LTV, really. It's a good LTV. So,
no.
Yeah. All right. Steve, how about you? Give me. And again, we don't need to run scenarios. Just give us a sense of where you are.
So I was fortunate enough to be able to pivot. You know, Nephi's a very small company, and my background's in the capital market space. I've been doing this business for over 30 years, running a few large mortgage banks in my past. And we were fortunate enough that I was able to lock on with a bank portfolio lender about 6-7 weeks ago to keep the program alive. And it was really critical that you had a warehouse line to be able to fund those loans with. So I have a warehouse line attached to a bank portfolio for a takeout for non-QM. And so I've had that on my rate sheet for close to 6 weeks now. And it allowed me to still keep the program going and provide liquidity to the mortgage brokers who we do business with. So we were very fortunate. The business is coming back. I'm in discussions with probably 3 or 4 different large insurance funds, hedge funds, and insurance funds right now. So I'm hoping to bring out more of my proprietary product here in probably 4 to 5 weeks. So I do have my bank takeout, and then I'll have my own niche product out in probably 4 to 5 weeks. So the market is coming back at definitely different prices. So premiums are going to be not as much as they were there in the past. And secondly, obviously, those guidelines are much more conservative. But there is life with the business, and I definitely see that coming back in the jumbo sector also. At Nefi, we do offer jumbo loans. And I've been out there with them for, since the beginning. We never took them off our rate sheet, and we offer them self-employed and W-2 borrowers. So we're still alive and kicking here at Nefi.
So again, why don't you just throw a max LTV at us?
Max LTV is 60.
Okay. And then somebody had likened the rates now to maybe non-QM 3 years ago. Does that sound about right?
That's correct.
I think it might have been one of you who said that to me.
Right.
All right, John, how about you?
Well, I think a couple things. One is sort of as it specifically relates to Angel Oak. We are as committed as ever to non-QM as we have been in the past. I mean, this is what we do. This is who we are, and we're just thrilled to be back and offering products back out in the marketplace. Serving this group of borrowers who couldn't get financing for a long period of time, and so it's great to be back. for first and foremost. But the reason that I think we're able to be back, and the reason why I think you'll see expansion of non-QM sort of from here, not just from here, but today is all the things that David started talking about in the beginning, which is states are opening up. You're starting to see some more activity there. The number of new unemployment claims, while it's still incredibly high, is dropping from its peak. The markets are beginning to thaw. The improvement that we've seen in the equity markets, I think, has been an incredible response, and really most of that is due to the Fed action that's taken place. And that Fed action, I think, has been important in getting us to where we are today. Because where we are today, as Carrie has said, is a sort of is a restricted credit box. But it's something that allows us to get back into the business, to evaluate credit risk properly, to price it properly, and we're able to do that because the Fed's been really aggressive in opening up some of these markets. One of the things that we've heard a lot about on this particular call every week is TALF, and TALF, while it hasn't played a direct part in supporting the non-QM markets, not even really played a direct part in supporting the RMBS market. But the fact that it's there, the fact that the Fed is out buying securities, is supporting the mortgage market in that way, has indirectly helped the non-QM space. It has indirectly helped that prime jumbo space, and I think that's an important part. So you're starting to see the market thaw, and part of that, and another piece of sort of great news for, I think, non-QM in general, not just for Angel Oak, but is the fact that we were able to get a securitization done sort of post-COVID. This is a really important marker for us, not just as a company, but again, for the non-QM space. I think it provides other opportunities for the people that we compete with on a day-to-day basis to say it's possible. You can continue to originate. Demand is still there. The securitization was oversubscribed. The fact that we could get that done in this way is incredible good news for all of us, not just for Angel Oak, but everybody else. Because there's still a lot of companies, unfortunately, that aren't open. Some companies that aren't going in the non-QM space, and that's unfortunate. In your business planning, you don't ever think of what would happen if there was a pandemic, where millions of people die. It's just not something you think about. And I've heard a couple other people say it on this call in the past couple months. I'm more proud than ever to be a mortgage banker. The way that the industry has responded over the last couple of people moving. The amount of volume that's happened with staff not sitting in your offices has been phenomenal. Just an incredible. I just love seeing all these posts by in the agency space of people hitting their top marks and new highs of volume. So I've just been very impressed with them, and I'm proud to be a part of this community. And we're just thrilled to be back and committed to the non-QM base. And just from a LTV standpoint, we did introduce a statement product to go to 6%, 24 months bank. We also introduced a service coverage ratio, investor cash flow loan, and we introduced that back into the market as well a couple weeks ago, and as well as a prime jumbo kind of just NIM full doc product.
Okay, so the audio is a little hazy right there. So just to clarify, and we are getting questions on the debt service coverage loan. So I know Carrie has that, you mentioned. And then what did you just say your max LTV was? I didn't catch that.
Yeah, we'll go to 80 on our bank statement product.
Okay. So, and just for the record, we will send, as usual, we will send this recording to everyone who registered after this is over. And we'll also include everyone's contact information. So for John, Steve, and Carrie, we'll send out how you can reach them. And Steve, if you want someone else to take that, if you want to give us somebody else's name to share with everyone so they can contact them instead of you, let me know that. Okay, so this is all good news. So again, we do have the debt service loan that's back, right? That's what I heard from at least two of you.
Yep.
Steve, do you have that yet?
No, I do not. No.
Okay. So, but things are changing constantly, it sounds like. So so let's talk about what you think the future looks like in the short term and the longer term. Do you think it's obviously things are going to continue to improve, but do you think pricing will get back to some semblance of where it used to be? Do you have any sense of timing whatsoever? And if you don't want to guess or don't have an opinion, you don't have to make something up. So you can just say it.
No,
Terry, why don't you go with you?
Yeah, and to be fair, I mean, our pricing has always mirrored the risk that we take, and we haven't had a huge hike in pricing, and we're still doing 0-point loans and paying our borrowers their lender paid comp. So we haven't taken a huge hit in the pricing, but I do see things, I think, getting better. And it's all, it's all everybody's outlook and how we're going to come out of this lockdown. It's been terrible for small business owners and people who, require us functioning as a society and being able to go outside and go to the store and do all the things that we're used to doing. And I think as we move forward and, we're seeing the COVID issues and hospitalizations and all that level off and go down, I think it's all very positive, and I think the market will respond to that, of course. So I think it's all a very positive outlook, and hopefully, it'll happen during the summer and start the road back.
Gotcha. And John, I'm getting a question. Is Angel Oak going to start doing correspondent again? Can you speak to that at this moment?
Right now we're not. Yeah, right now we're not. I think that a lot of businesses can depend on what we talked about initially, which is just access to liquidity. Right now the ability to get a warehouse line at harder than it was before, certainly on the non-QM side. But I also think that there's going to be some hesitancy on from a decent group of size of mortgage bankers who stepped into this space and then had some difficulty getting out of it during the pandemic. So I think it's going to be a little while until you see the correspondent business come back. We're reopening on the wholesale side only. So this is, we still have a long way to go.
Right.
Asked on 60 Minutes the other night about how long it was going to take for the economy to get back, and I think his response was appropriate and it applies to the non-QM solutions. It depends on COVID. It depends how quickly we can get through it. It depends how quickly we can get a vaccine. It depends on what Carrie has talked about, how quickly we can get people back to work. These are all, so it's definitely going to be back, and the reason it's going to be back is because we're doing good loans to good borrowers who pay. That's sort of the heart of our business. If you told somebody you're going to start a mortgage company, what's the first thing you need to do, and that's make loans that pay. That's what we were doing at the heart of it. So I believe in the power of the borrower and the U.S. consumer, and these are good credit. But the other thing too that I think it's important, and really for this group, is the non-QM education. It is not complete, I wouldn't say, but it's very thorough. So at every level, the institutional bond buyers that Steve's talking about, the several non-QM wholesalers now, or at least were prior to this, originating non-QM loans. You have loan officers that for a long time hesitated to produce non-QM product. Prior to this, were originating and non-QM product to their clients. And then to take it to the sort of the nth levels, is we had, borrowers knowing about non-QM, borrowers knowing about a bank, how can I get a bank statement loan? So the entire system has sort of been educated. And the reason why I don't think it'll take that long is because of that. You have sort of the foundation of good loans to good borrowers, but then you also have an awareness of the non-QM space. So we found in those first couple weeks of reintroducing our product, the demand from the broker community was amazing. And so there is still an incredible demand for the product, and not only from the origination standpoint, but from the investor community as well. And as a result, I think you'll see the market come back pretty quickly.
Does anyone have a sense of how many non-QM loans went into forbearance or have gone into forbearance? I haven't seen those numbers. We've definitely heard from FH.
I saw something, Audrey. It was single digits in March, and it's in the high 20s, low 30s in April. So that's a pretty big number for loans that go to forbearance in that space. And jumbos are kind of seeing the same numbers. And so
wow.
my view is that until you really see the jumbo securitization come back first, non-QM won't come back. So you really have to keep your eye on the jumbo business and the big buyers of jumbo loans coming back into the market. So right now, fixed rate jumbos on our rate sheet are in the middle fours, and obviously you can do much better at a bank for a fixed rate jumbo. And I depend on the securitization market for my jumbo execution. Until you really start seeing that come back and spreads starting to tighten, the non-QM will follow that, and then you'll see rates start to tighten and come in. But right now, I really keep an eye on the jumbo sector, and that's really going to give you first sign that the non-QM business is really going to start come back, and you're going to start seeing a little bit more in the premium pricing and the tightening of rates.
Why do you think so many more non-QM loans are in forbearance than, like a Fannie Freddie loan? I mean, is it because those are the self-employed borrowers and they've been shut down for 2 months? Is that okay?
Yeah, that's correct.
All right. Wow. All right. So why don't we go to some questions? So,
Audrey,
yes.
I was just going to say, I think the thing that's important. Can you hear me?
Hey, you're breaking
there
up.
We go.
Can you hear me?
Now I can.
Okay. No, I was just going to say one thing that's important is not necessarily the level of forbearance, but what will happen after people are out of forbearance. That's going to be the real big question that I think will determine. And I think the other thing that will happen is you'll see people like Angel Oak and others that are servicing this portfolio narrow down sort of where those forbearance requests came from, and that will help, I think, the future going forward.
Well, I think it's also a good reminder on make sure you let your self-employed borrowers understand that they should apply or reapply for the SBA money. There's still a lot of it out there, and that would be a good way to. Yeah, right. There you go. Mm-hmm. Yeah, it's really important because there's help, but it's hard to get to sometimes for some people. Okay, so are you able to do a lender paid non-QM loan? That's a question that's happening that's coming up.
Yeah, we can.
You can. Great. Mm-hmm. And then they're asking what the max premium is now on a non-QM loan, and also the max LTV on the rental property loans.
Was that for me or for
any of you is good?
So premium being the lender paid comp, we pay 1 1/4 across the board up to 20,000. And
okay, gotcha.
My rates are in the 5s on ARMs.
Gotcha.
Right now we're borrower paid comp only, and max LTV on our investor cash flow product is 70%.
Okay. All right. So that gives us a sense. Let's see. What else do we have?
The Helocs. You guys talk about the Heloc market.
Yeah, sure, Kevin. I can talk a little about the Heloc. So at NewFi, I've been fortunate to have a piggyback program since the inception that I started this company 6 years ago. So right now I go to 85 CLTV for cash outs for a first and second combo. My rates on the second is a 6%, and I'm coming out with the Heloc second mortgage, the 85 cash out, first and second combination with a 4% no rate, so 3 1/4 over prime, and that's going to come out next week. So I really view the 85 CLTV business, the cash out, it's full doc, but it still has some non-QM features to it with respect to the cash out requirements, and cash outs are so tight now in that space with respect to loan level price adjustments. So at NewFi, we've been able to pivot a little bit with our piggyback program, and we've seen a lot of success in that area.
What about
That's really good news.
Yeah. What about the market behind the scenes, though? What's causing the tightening up this for other LOs? Why are we seeing, like last week, we saw a couple lenders disappear, well, 3 weeks back now, that were doing just HELOCs, and they got out of doing refinance cash outs. They will only do purchases now. And then I have another one just Monday, they've raised their rates by, half a margin, or the margin by half a point. I'm assuming that's just liquidity issues.
I think that, I'm guessing those are banks. I think I know one of the names. I think that's more credit, Kevin, than anything. They're just tightening up on the credit side. It has nothing to do with liquidity, just more credit.
It's risk.
And more conservative, yeah.
God, really good to know that there's cash out refinances on a HELOC out there. That's new news for me. So yay. Okay, so we have a question about people with non-QM or doing non-QM loans and who are in forbearance. So do you have a policy in place on how long someone needs to wait after forbearance to do a non-QM loan?
We do not. We haven't established that yet. It's just too early at this point.
Same.
But I think the good, the FHFA announcement today was a great announcement. I think we'll set a pretty good precedent going forward for the non-QM space.
Do you think?
Well, obviously can't.
You think you'll follow suit?
Yeah, I don't even know what tomorrow looks like, so I'm not going to use David Luner's incredible prediction model and step into that one.
Yeah. We're always open to case by case exceptions, or just looking at, we don't have a guideline regarding that either right now. So it's always doors open. I'm listening.
Gotcha.
And I think that's the beauty of the non-QM space, is you can make reasonable decisions, and I think that's sort of where we'll end up. If you can prove that you're back to work and things are all good and you can explain it, I think that's probably where we'll end up as well.
Okay.
There's a really good question. They're saying on bank statement loans for self-employed borrowers, how are you going to look at somebody who didn't have income in March, April, May, potentially June, when you're averaging income? How are you dealing with that when you're underwriting? That's such a good question.
Taking an average. We're doing a 12-month average right now, the most recent 12 months. So it just works into the average, and I'm still proving them. So, we just we have a business narrative that we require borrowers to write to us and tell us about their business. And we look at, again, case by case.
All right. So you're not holding it against them necessarily, but it's averaged into their 12 months or 24 months. All right. Anyone else?
I was just going to say, I think it has to make sense. You got to show that you're back to work, your business is reopened, you're back to work, and as the case, then you got a pretty good shot.
So you're not going to exclude those months, though, or if somebody got SBA funds that are tiding them over, or there's no accommodation for those missed months or different months.
There could be.
For us, yeah, I think for us it's too. I think for us it's just too early. We just haven't seen enough of them. I think most of the loans that we've come through have been businesses pandemic. I have enough history to really predict it.
Right. Yeah, states are literally just opening up right now. It'll be interesting. Right. We'll have to circle back around on this question in 2 months, right, and see where we are then.
Perfect.
Okay, so here is a question about, are you doing any foreign national cash out refinance, non-QM, second home, no income qual, just everything?
Wow.
I check all of the boxes.
I don't know that if that's all one loan or if that's second home investment property.
Right. Well, we do foreign nationals up to 60 LTV, up to a 3 million limit. And then once you're over 3 million, your LTV is going to go down. We will not do a no income loan, though. We always have to show ability and willingness to repay. But that said, on a foreign national, that's not necessarily 2 years of tax returns and perfect US credit. I mean, they don't usually have either. So that said, we can usually make it work with alternative documentations, but it's not no income. It's not like some of my other competitors in the banking industry on that.
Anyone else?
We offer cash out on our bank statement product, not on our debt service coverage ratio. Debt service coverage ratio is purchase rate and term only. No foreign national. Too early on that one for us.
And we'll have foreign national out next week, Audrey. So.
But as Carrie, yeah, go ahead.
Okay.
Yeah, we're at a 50 LTV.
Okay, that's great. So they're asking, do you still have asset depletion for purchased jumbos? Yes, I see Carrie shaking her head. Yes.
Yeah, we do. Mm-hmm.
Okay, great.
And we don't have a limit on cash out. Just FYI on the cash out question.
No limit. Wonderful. What about other non-QM products like 1099, 1-year tax returns, 1 year for major credit events? Are those still available? Anyone? Chime in.
Yeah. Can you repeat all those? The 1 year from credit event, we probably would want to see right now some pretty clean credit. And, if it was a true extenuating circumstance, always I'm willing to look at that. What were the other specifics of that question?
1099, 1 year tax returns.
Yeah. Yes. That's always been
yes.
something that we've specialized in. Yeah. Mm-hmm.
Okay, very good. And Carrie, this might be for you because they're asking about a good place in Orange County to apply for a PPP loan. Gosh, I can't find it right now.
AccessBank.com.
Okay, so do people have to have an account with you to apply for a PPP loan?
I don't know. That's a really good question. There was a recent article in a local San Diego newspaper talking about Axos Bank and our SBA loans and what we've been doing. And it was very complimentary. So I know that we're on top of it. I don't know about the banking relationship. I would assume that they would want to establish one, but do you already have to have one? I doubt it.
Why don't we check on that, and then we could send a note out when we send our email, and we can answer that question. Does that work? We'll circle. Okay, sounds great. They're asking whether you think some of the places that have gone down are going to come back once coronavirus ends, and God bless. I hope it ends. And what non-QM will look like at that point. So do you expect your competitors to come back into the market? Do you have any sense about whether those who've gone down are staying down, or they're getting back up, or is it a mix? Or tell us.
Depends on how solid they were before all this went down.
So out of the 5 major conduits, 2 are back out of the 5. I know 2 are completely shut down, but at least 2 out of the 5 have come back.
Wow. And then there's a 5th that is.
I think. Yeah. I think the big difference between what you're going to see over the next. Yeah. Can you hear me?
Yes.
Can you hear me? Okay.
Yes.
Yeah, I think the big difference between what you're going to see over the next, 12 months and what you saw there were probably, 50 wholesalers selling non-QM products. I mean, I'm taking a wag there, but I mean, it was a big number. Pretty much anybody that was selling on a wholesale basis, and even some correspondents were selling non-QM. So it didn't matter whether or not you were an agency lender and you were adding non-QM product to your portfolio, or whether or not, you were just getting into the non-QM space. Everybody was selling it. So I think what you're going to see is you're just going to see fewer lenders get back into the space over the next 12 months. It'll be a slow trickle back in. We're still early. This is we still have a lot of wood to chop, as they say, as a performance. So we've got to get these loans, some of these loans closed at higher up using bank statements, et cetera, and see what kind of performance those loans have, and make sure that there's continued demand on the secondary market before you see. Another piece that we didn't really talk about is the rating agencies have to go out and they, to give them a lot of credit, they got hit pretty hard, a decade ago, but recently I think they've done a pretty good job of identifying risk and determining value and helping people sort of move into the securitization market. So I think that how they respond will also dictate how quickly you'll see wholesale competitors come back to the non-QM part of things.
So, and Audrey, you have a couple of things happening. One is we're in a rally, right? So everybody's busy. And margins are really good on agency and FHA loans right now. So for a lender that was doing a lot of generic business just to roll out non-QM business when they're super busy right now, it doesn't make sense. I mean, I'm having record weeks right now just doing agency FHA loans with a little non-QM and some jumbos and piggyback loans. So we're super busy. And then secondly, like John mentioned, I mentioned before, the warehouse banks have to come back, be able to lend mortgage bankers money to sell to somebody. And that's going to be really slower to come back because they're going to require a lot of capital and collateral to fund those loans with those warehouse banks. And that's going to take a lot of time. So the most well-capitalized non-QM people will come back first. The people who have unique relationships like we do at NewFi on Wall Street and different hedge funds, will come back. And the people that are not scared of the product, and at NewFi, I used to be CEO of Greenpoint Mortgage. I ran GMAC. The product doesn't make me nervous. We're comfortable doing the paper. I'm comfortable with the credit risk, and we'll definitely dip back into it in a much bigger way as I continue to find takeouts for the paper.
Got it. So I have a question, David. I don't know. This might be, well, any of you, I guess, especially maybe Steve might know too. Somebody said, I have a lender who says they just closed a refi that where the borrower was in forbearance last month and just had to bring it current before they'd fund, didn't have to wait 3 months. What is that?
Well, if they didn't request to go into forbearance, I mean, it was just somebody that pushed a button that, somebody called and said.
It didn't, it doesn't specify here.
Yeah, so if they were never in forbearance at all and they were current and they made their payments on time, again, they were not in forbearance. So it wasn't that time.
One thing you have to be careful. If that showed up on the credit supplement, they're stuck. If there's any documentation around that, then it's going to be hard to get a loan.
Absolutely.
Right. I mean, so even if they closed it, they may have trouble down the road, right, with selling it or, okay. Yeah. It kind of goes, what?
The LO just got lucky, I think.
Exactly.
Well, lucky, maybe for the moment, but gosh, that kind of stuff can catch you later. So there's a question about who are the 2 out of the 5 conduits that have come back into the market, and who are the 3 conduits that are still out? Is that something that you can speak to?
I read enough mention things. Yeah.
Angel Oak is here.
Okay. Okay, so who has cash out second home asset depletion? Oh my goodness. With business assets and allow some W-2 income to qualify max LTV, should they just contact you directly for these scenarios when we're done here? Okay. So we'll keep the specific can you do my loan conversations for afterwards. All right.
Thank you.
So we are getting close to the end. Does anyone have anything that they'd like to add as we wind this up?
Just looking forward to purchase season. I'm hoping everybody's going to get out and start buying houses again. And, we're still doing a lot of purchase money loans, departing residents, cross collateral bridge stuff. So looking forward to more of that and hopefully everybody getting back to work.
Amen.
I would just say thanks again. I appreciate all you guys are doing. We're like I said, I'm proud to be a mortgage banker in this environment. And for those of you who can, speak up, spread the good word about the mortgage business. Ask you and get in touch with your senators and don't assume somebody else is going to do it. Make sure you reach out and make that phone call or send that email. You guys have made it so easy for people to get involved, and I just say stay involved because it's had an impact. And the FHFA announcement today is one really good example of how our voices are being heard. So just continue to speak up, and I just appreciate you having me as part of the conversation today.
And before we get to you, Steve, I just want to say that when those calls to action are sent, you can forward those. People don't have to be NAM or CAMP members. You can send them to your family, explain to them how important it is that our legislators hear from everybody. So again, feel free to share those with, paste them on the bathroom wall, whatever. I mean, make sure that the word gets out as far and wide as we possibly can. So Steve, do you have anything to finish up with?
Thank you for the invite. I really appreciate it, and it's definitely feeling better. It was a tough 3-4 weeks in this business, and walking every day, not knowing what's going to hit you next was I ran a big company through 2008, and this was 3x the volatility and the excitement of 2008, and I'm happy to be able to get through it, and I'm happy to see a lot of my competitors get through it, and overall it's good for all of us, good for the industry. And I think we're in a really good spot as we move forward and have rates where they're at. I think we'll be down here for quite some time.
I have to say that I agree 100%. It felt like we were in a war for the first few weeks of this. I mean, it was, the hits kept coming and it was fast and furious. But I just am so thrilled to see our industry come together again. That's how it felt, where you're just, we're all mortgage professionals. That's it. We are, wherever you're doing business is less important, and that you're doing business and helping the consumer, that's really all that matters. That's what we're all here for. So that's a beautiful thing. Dave Luna, what do you have to finish up our day?
No, I'm seeing that the cities are opening up. People are going back to work. Unemployment should start to drop. Rates will still be low for a long period of time. With FHFA's announcement, the late summer, fall, winter might not be as bad as everybody thought, and going back into 2021, at least for spring buying season, it's going to be amazing. We are going to be making a lot of families happy and ourselves a little bit of money too. So the next little bit looks really, really good for the foreseeable future, for at least the next 2, possibly 3 years. So I think it's going to be really, really good. All the indicators are just showing that it's going to be very, very positive. So congratulations, everybody. And I think the worst is behind us, unless some sort of other, explosion happens of news, not literal explosions, but you know what I'm saying, some sort of, things that we didn't see, because stock market is reacting very, very favorably to the news that maybe in human trials we have a COVID-19 a medical solution. I think that's fantastic. I think that's amazing. So let's hope that the news continues to be positive, because all the other indicators are showing a very, very good next few years.
So to recap, the good news is great. The worst news is behind us, unless it isn't. And join us on Thursday evening for our camp happy hour. We welcome all of you. We expect to see your smiling faces, our panel. And join us on May 28th for the NMLS class, and next Tuesday for our mortgage market update with Dave Luna and whomever else we might drag into the mix. And with that, have a wonderful week, and I will look forward to seeing you again next. Bye.
Thanks, everyone.
Thank you. Bye.
Thank you.
Bye. Megan, are we done? All right. Thanks, guys. Appreciate it.
Thanks, Audrey. It was fun.
Have a good day. Bye.
You too. Bye, Kevin.